Official claims are up 4,000. They would have been up 6,000, but that 366K originally released last week has now been moved up to 368. So we moved 368, tack on 4, 372,000. Continuing claims, they're hovering a little bit higher than 3.31 million. No real feature to that area at the moment. You know, it's fascinating. We see that the bond yields have done a beeline towards 140. Our yields intraday, about what, 40 hours ago, high yield was 186. We're now at 169. We're at 173 before the minutes to the last Fed meeting. So I think, you know, some of the issues in Europe resurfacing as August starts to wind down and the agita of global economics starts to wind up. Certainly seems like the big dynamic. The dollar index, of course, really was tagged in a lasting way yesterday. It's down a bit today, and the euro currency is closer to 126 than 125. Back to you guys.
Rick, real quick, what's going on? I saw earlier today, it looked like some of the Spanish yields ticked up. Was there more concern about Europe not doing the right thing, or not the right thing? I don't want to make editorial comment there, but not coming in, the ECB not coming in and buying bonds?
Well, I think that the debate,
right.
The debate is growing more intense. You know what? I like that Freudian slip. Stop right there, not to pick on you. But what do you think is the right thing? And I'm not trying to give you grief. I'm curious. What do you think? If you had complete control, like the Merlins you have sitting at the table this morning over Spain,
Rick,
what would you do?
I have long maintained that in order to have a single currency, you've got to have a single central bank that acts like a central bank. And I think a central bank needs to be able to back up a currency. And I don't think you can have it both ways. Either dissolve the union or let the central bank act like a central bank. I think that's the right thing to do.
Well, can you do it?
Don't you think that's a significant violation of the tenant, no taxation without representation, considering one country
or a violation of the Maastricht Treaty? Yes, I completely agree with that. But I'm just saying the Maastricht Treaty, I think, as designed, is wrong.
I got you.
I think it's wrong. I don't think there's any way. In fact, let's ask Jim Bulard. I mean, can you stick with us, Rick? Because you may have want to weigh in on this. Is it right to have a central bank that cannot go into the markets and buy and really back up a currency?
Yeah, I was saying earlier, I don't really like intervening in particular markets by the central bank, either by the Fed or by the ECB. I think it's a bad precedent. You're helping particular countries or particular markets, and where is that going to stop? That seems to me to be a road to politicization of the central bank. Now, I agree that Europe's in a very difficult situation here, but still, I want them to behave as a central bank. I want them to do things that are good for Europe as a whole and rationalize their policies because they're the right thing to do for Europe as a whole.
Yeah.
And you know, I sure don't want the Fed to get into, hey, we're gonna help you know, these guys over here, this little market over here. That seems like a disaster to me.
I would argue even that the problem is that they don't have a fiscal authority, the one fiscal authority that speaks for the entire.
I don't disagree. I don't think that's the only problem, though. I think it's also a problem. You get to a point where you're at the zero bound, and in Europe, effectively, your policy tools are done.
Hostess, baby. It's hostess. You heard what it was. Jim agreed. It's like hostess.
You know, Kaminsky, why does everything relate back to Twinkies with you?
It just
everything relates back to Twinkies.
Can I ask you something about interest rates? Rick, go back to the 10-year. It was only, I think, 48 hours ago when you and I were at the New York Stock Exchange. We had a bunch of people coming up to us telling us, you know, you saw the low print in yields on the 10-year, and in fact, the interest rates are going to be one directional the rest of the year, move higher. What happened in the last 2 days, right?
Well, I'll tell you what, listen, it's hard to call every bump in the road when you have the boys on Mount Olympus tinkering with our markets. But I do think that over the last 72 hours, most of the people I talk to, Gary, really think the market has reversed. And I think it's evident by, you know, some of the relationships going on in Europe. Even the 10s to 2s Spanish spread, which I won't pay as much attention to today as I would have 3 months ago, has had some flattening. Things have turned a bit.
All right, Rick, thanks very much. Stay right there because I know you're going to want to hear an answer to the next question. And now more from our guest host, Jim Bulard. Yes, Steve?
I just want to ask a real question. Real quick question. 370 on jobless claims is consistent with what kind of payroll growth?
I think it's still consistent with moderate payroll growth, 150.
Okay.
On the claims number, I wouldn't get concerned unless it went over 400 again.
Okay, that's the threshold number.
And that threshold works pretty well, surprisingly well, and so I think as long as we're hanging around below that, we're okay.
Can I ask another real quick question?
Jump in.
So I know you don't like tying this back to QE3 and what it means for QE3, but if you see numbers like 370 on the weekly jobless claims, you see numbers like a 150 on the monthly jobs report, job creation of 150, is that enough to keep the Fed at bay?
I think, 2% growth, 150 on jobs, claims down below 400, that's kind of middling data. I don't think that the FOMC, at least in my view, can take gigantic action based on sort of just the fact that you've got muddling through kind of data. Now, if recession probability started to go up sharply and you're worried about the future, something like that, then I'm sure the committee would come in. But this kind of going along at this kind of slow pace is not enough to justify gigantic action. In normal interest rate times, you might ease a little bit, but you'd ease 25 basis points or something in that situation. You wouldn't say, all hell's breaking loose.
So but I hate to parse your words, but you said not gigantic action. That doesn't mean no action.
Yeah, it doesn't mean no action. So I think that's the question that's on the table for the committee is what exactly, if anything, but what exactly.
But hold on. I'm sorry, Guy. I got to follow up on this.
Yeah.
We got to get
and I will let you go.
You just don't want me to ask the question.
No,
I know exactly why you don't want.
Yes, I completely support it, but I need to follow up on Becky's thing here. It sounds like what you're saying is you would potentially support a decision of the FOMC to do a monthly incremental meeting quantitative easing, given current circumstances in the economy.
I wouldn't do it right now. If it was just me and we just had the data up till today, I wouldn't do anything. I wouldn't take a decision right now. But I've said in the past that I'm willing to support this in some circumstances. I'd like to see, before we did that, some kind of deterioration or indication that we're going to slide down further, and then I'd become more sympathetic, and if we did it, I would want to do the month-by-month thing that I've been advocating for quite a while. So that's where I am.
All right, Jim, with apologies to Steve, my buddy Steve here, because he may not like the answer. There's 1 million+ people in this country that have followed the rules. They kind of plan for their retirement the right way. They've been severely penalized. We get emails.
Tens of millions.
Well, we know it's in excess of 1 million. I use the number in excess of 1 million that have followed the rules, that have basically invested in fixed income because they plan for a retirement and they did not live above their means. They write in every day. Here's just one example. What about this impact on low interest rates on those people that follow the rules? They are the most penalized as a result of all of this manipulation of interest rates. What do you tell them how they're benefiting as a result of everything that's happened here with quantitative easing? Well, because they certainly don't feel like they've gotten anything.
I know they don't, and I am sympathetic to this. I have been saying that savers are being hurt by our policy, and the Fed lowers interest rates in response to a recession, but this is going way beyond business cycle dynamics. Business cycle dynamics are supposed to be 6 months, a year, 18 months. We're talking 5 years, 7 years. So this is going way beyond what you would normally do in a business downturn. Normally you would come back and then those people would get their higher returns. Here you're knocking out a whole generation of people that are close to retirement and are trying to get returns here. Our models do not take proper account of that, and I think we need to pay more attention to it.
You're not going to give out specific investment advice, but
Here's another way to say this.
Yeah.
This country is over indebted, and all of our policies are, encouraging people to take on more debt.
Right.
Why are we doing that? And then if you decide to cut back, government goes and borrows on your behalf. So I think our bias in the monetary policy world toward everything's got to be let's run up some more credit when the economy's down is, I think, us as a macro community, we don't have our heads around exactly this problem. How are you damaging saving over 5-7 years when you have this really low interest rate policy? So
it's a big concern.
It is.
And fortunately, we have a little more time to talk about this.